Hey everyone, Carvana stock is still down 81% off its high, despite recovering strongly from the bottom in January 2023. So I'll evaluate Carvana stock in this video here and answer whether or not I think the stock is a buy now after recovering from its difficult challenges in 2023. So let's jump right into it. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now. So I highlighted that Carvana stock is down 81% off its highs in 2021, and it's jumping from the bottoms around January of 2023. Now, the company did have challenges, which I'll talk about in this video here. Now, in its latest year, the company set new record for profitability, achieving $150 million in profits on the bottom line, although that was more due to a debt extinguishment and some one-off items, and not really a profitable bottom line on the business overall. Nevertheless, the company did improve its performance. Most notably, the total gross profit per unit reached a new full-year record of $5,511. That means on each car that it sells, it made $5,500. That's impressive. That's the core of the business, right? It buys used cars and then sells them, and how much money it can make from that process will determine how much money investors make from Carvana. So this is the most critical metric I consider when I'm evaluating Carvana stock. And this is the metric it had the most trouble with in the changing, unprecedented environment during the pandemic. Remember, used car prices soared during the pandemic because there was shortages of new vehicles. So people who needed a car went to used vehicles because they couldn't find any new ones available. And so that caused a bit of a boom for Carvana. And then they faced the flip side of that equation because when vehicle prices were soaring, Carvana was paying higher prices to buy those vehicles. And then when the supply of new vehicles increased, Carvana was stuck with this inventory it paid higher prices for, and then it had to sell for lower prices. And so the gross profit per vehicle was negative for a time because of that imbalance, because of that unprecedented change in consumer purchasing behavior and the change in prices during that time. The car market was all kinds of discombobulated during the pandemic. That's what fooled a lot of investors. That's what got investors a little bit off kilter, off balance, and made investors feel like a lot of these EV companies, remember, there was that frenzy around EV companies. It was because of how discombobulated the vehicle market was. It made these EV companies look like they had more demand than they actually did, because consumers just needed a car, and whatever car was available, people were paying higher prices for, as was evident with the used car market, right? There was used cars that were selling for higher prices than people bought them for when they were brand new. I got a quote for my car, my used car, which I bought in 2018, and I got a quote in 2021 that was paying me a higher price for my car than I bought it in 2018, even though it now had tens of thousands of miles on it, and it was 3 or 4 years older than when I purchased it. So that didn't make sense, and that was unsustainable. And if you were thinking that the car market would have remained in that position, you were not being, let's say you were being short-sighted, to be friendly. That was a short-sighted view of the car market. So now the car market is rebounding, rebalancing. It's still not where the normal situation would be, but it's rebalancing. And you can see that across the board. Car prices are coming down. EV market demand is decreasing significantly, and supply of new vehicles is increasing. And so it's coming into better balance, and it's actually working in Carvana's favor right now. So in 2023, Carvana sold 312,000 units for a total revenue of $10.77 billion, and they recorded a record gross profit per unit of $5,511, which was up by $2,489 year over year. So they nearly doubled their gross profit per vehicle year over year. That's truly impressive. So for the next quarter, they're expecting retail units sold to be up slightly year over year, and the company expects the retail gross profit per unit similar to fourth quarter, with potential for upside, and the sequential reduction in SG&A expense per unit sold. So not only did the most recent quarter finish strongly and the most recent year finish strongly, but management expects the next quarter at least to be just as strong, if not stronger. For the full year in 2024, Carvana expects gross retail units and adjusted EBITDA compared to fiscal year 2023. So they're expecting another strong year in 2024, just like they had in 2023. So their prospects are strong. They delivered a good year. They're recovering, and you can see why the stock price is up off the bottoms in 2023. They're no longer in that panic mode, that panic situation they were in 2023 and 2022, when the car market changed drastically and they were caught in a very bad position with inventory that they overpaid for and they couldn't sell at the prices they sold for. Still, if you look at Carvana's balance sheet, it's not in great shape. It's recovering, it's getting better, but it's still not in great shape. They have $530 million in cash and equivalents, and they still have $1.15 billion in vehicle inventory, although you could see that's down from the $1.876 billion. So they've done a good job reducing the inventory. They did less buying and more selling, and that drew down their inventory balance, and it increased the cash. That's what they needed. That's what they needed because they had to borrow a great deal of money. I'll share with you just how much. So their debt increased, their long-term debt increased to $6.574 billion. And they were able to reduce that to $5.4 billion by using some of the cash from the vehicles they sold to extinguish some debt. Still, they've got a long way to go in terms of reducing this long-term debt. And I would think it's advisable for Carvana to continue on this path, using the cash they generate from car sales to pay down long-term debt, because they borrowed a great deal of this money when they were in a desperate situation, which means they had to pay higher interest rates. They had to agree to higher interest rates due to the position they were in of desperation. They just needed to take whatever they could get. And so that means higher interest debt. And now they are generating cash flow again. So it would be prudent to use some of that cash flow to pay down this debt. So I mentioned they're generating cash flow again. And for the full year in 2023, Carvana generated $803 million in cash flow from operations. And that was a big improvement because the last 2 years, they were negative in this metric. You can see in 2021, negative $2.6 billion. And then in 2022, $1.3 billion negative. And then finally in 2023, positive $803 million in cash flow from operations. And so you can see in 2022, vehicle inventory. So when you see that number in parentheses, this $2.1 billion, that means cash left the company for vehicle inventory. That means they spent more cash, $2.1 billion more cash on inventory than they brought in through car sales, just in terms of cash leaving and cash coming in. Every time Carvana buys a car, that's cash leaving the company. Every time Carvana sells a car, that's cash coming into the company. So in 2021, $2.1 billion more in cash left the company through car purchases than came in. They tried to rebalance that in 2022, and $1.35 billion more came in than they purchased. They reduced the purchases in 2022. They wanted to sell off some of that built up inventory. And then they did the same again in 2023, $711 million more in cash coming in for car sales than cash going out. And so that has helped the company draw down its cash going out in vehicle purchases and increase the net cash from operations. Although they can only do this so much. They can only draw down inventory so much. Now, they still have elevated inventory levels that they can continue to draw down, but longer term, there needs to be more of a balance between purchasing vehicles and selling vehicles. And they can't continue to have this positive number in terms of vehicle inventory, at least not such a strong positive number. In fact, if they plan to grow the business, this number needs to be negative. because that means they're building up inventory for growth. But right now, they're not in growth mode. Right now, they're just in a mode of trying to right-size the business and trying to rebalance the business and recover from those desperate situations they put themselves in, getting caught off guard between consumer behavior and the rapidly changing environment. So that being said, the stock is now trading at a forward price to sales of 0.627, which is up significantly off the bottoms reached in January of 2023. But the balance sheet is still not in a position where I would feel comfortable, and the company is still in recovery mode. So all that being considered, if I had to answer if I think the stock is a buy, hold, or a sell right now, I would say the company is a hold. I don't think it's a buy in its current position. I think it still has more work to do to improve the balance sheet before I can recommend Carvana stock as a buy, but it's making great progress, and I hope to see further progress from this company. Before I let you go, let me tell you about the greatest deal on YouTube. With just a click of a button, you can get free financial analysis from a professor with decades of investing experience. So what are you waiting for? Hit that subscribe button, and I'll see you again soon.